Hello and welcome to this Forex Preview at XM.com. I'm Maria Pachardis, and joining me is investment analyst Christina Parthenidu. We'll be discussing upcoming UK data and the outlook for the pound. So Christina, this morning monthly GDP growth figures showed a weaker than expected expansion in the UK. But more data is on the agenda this week. We'll get February's employment data on Tuesday and then CPI inflation figures on Wednesday. What are we expecting from all this data, and how might the Bank of England's policy settings be affected?
Hi, Maria. That's right. The UK calendar will be relatively busier this week. As you have already mentioned, monthly GDP figures for February came out weaker than expected at 0.1% compared to Reuters' forecast of 0.3%. But the three-month average was slightly stronger than what analysts projected at 1%. Well, overall, that is still keeping GDP growth flat for the year. So, in other words, the data show that the UK economy is not making a great progress yet. Nevertheless, February's data are not including the impact from the war in Ukraine. So the next GDP release could be more important. The Bank of England is concerned about a potential growth slowdown because of the increasing sanctions against Russia and the supply disruptions from the war. And that is probably the main reason why the central bank decided to become more careful with monetary tightening. It has already raised interest rates 3 times this year, but the ongoing geopolitical tensions in Ukraine have become more complicated, and that's increasing the risks for a growth slowdown. So the central bank has decided to become more careful with monetary tightening, and during the previous policy meeting, it didn't mention the case for a sharper 50 basis points rate increase. Well, apparently more is needed to be done since inflation is not showing any signs of fading. Several economies have reported higher inflation readings in March, and the UK may not be an exception. CPI inflation readings for March could jump to a new 30-year high of 6.7% on Wednesday, and that could add more pressure to the central bank to move forward with its tightening plans. However, given the growth risks, the central bank may look at other data as well. Employment figures, for example, could come next into the spotlight tomorrow, and perhaps the data may not be great, although employment growth could turn positive at 58,000 in February compared to a 12,000 contraction last month. That would still be among the lowest prints in a year, and probably will not be enough to push the unemployment rate below 3.9%. As regards wages, excluding bonuses, average weekly earnings are expected to increase at a faster pace of 4% year on year. That is below the inflation rate, but it's still a sign that the UK labor market is tight, and perhaps the labor shortages are forcing businesses to provide higher wages to attract employees. If wage growth increases, persist, that could consequently create a second round of inflation pressures, which the central bank, of course, would like to avoid. So in this case, monetary tightening is more preferable, and the data could justify the 4 rate increases, which are well priced in future markets. But I suspect that the central bank will wait and see the economic impact from the war in Ukraine before changing its recent cautious tone again.
So depending on the strength of the data, what reaction are we likely to see in the pound?
Well, today's GDP data didn't affect the pound much because probably investors are more interested about the next GDP releases, which will include the war factor. Employment figures could be considered outdated as well, and another pickup in inflation wouldn't be a big surprise either on Wednesday. Perhaps a significant negative surprise in jobs data could press the pound lower, but probably only temporarily. So overall, I expect only a short-lived volatility for the pound. Now, technically, a break below 1.13 pound dollar could, of course, bring selling pressures back into play. And in this case, I expect the price to decline towards 1.2920. Otherwise, I would like to see a clear break above the constraining zone of 1.3128 and 1.32 to become more confident that upside moves will persist.
Christina, thanks so much. And thanks for joining us at XM.com.